The topic for today is about power play in the boardroom of a public company. Why do we have to talk about the boardroom? Because if we know what's happening there, if we can figure out what's happening there, we can understand more about the stock market, stock prices, outstanding shares, and especially initial public offering. As you know, the stock market influences the membership and the decisions of the boardroom. And vice versa, their decisions also influence share prices. To figure out what's happening in the boardroom, you don't have to be a member of the board. All you need is to exercise some common sense, assume there's a profit motive involved, and people are out there to make a kill in the stock market. And in order to make a kill, you need to exercise control of the company, and you need insider information flowing from the company to the board. Most of the new companies, when they are established, it's very hard to survive because it's very tough out there. And even fewer can make it to IPO. IPO means initial public offering. When a company decides to go public, that means it wants to invite outside finance. Outside finance has to come from people with a lot of financial resources, especially venture capitalists. And the venture capitalist usually has good connections with the investment banks who can back them up, and also mutual funds, and of course Wall Street. You can see that when somebody invests money in a company, it's not a free lunch. They want to get something back out of it. So the motive is all about profit. It's about control. It's about division of the pie. Now let's try to understand what's happening before the IPO time, when a company is ready to go public. So everything has been negotiated, everything has been arranged. First of all, very important is the pie division. How do you divide the future profit of the company between the handful of investors who started out with the IPO? Of course, you have to think about the shares. And when you think about the shares, they divide the shares into two kinds, vested and unvested. Vested means when you get the shares, you can sell it right away at IPO time. Unvested means you get the shares, but you cannot until a specified time later. For example, 1 year or maybe 2 or 3 years later. And the shares are also divided into two kinds. The first kind is the preferred shares. The other kind is the common shares. Common shares are for you and me. Preferred shares are for those who have a controlling interest in the company. So there are very few preferred shares, and they are not normally traded. A preferred share is usually worth more than a common share. Now, what is going to happen to the company? The founder is usually to be the chief executive officer and chairman of the board. Of course, he has a vested interest in shares. He has both vested common shares and preferred shares. There may be another founder, then the other founder will get the same treatment, a seat on the board, and similarly vested interest. What about the other member of the team? Well, only a handful of the top staff are granted vested interest. Why? Well, it's just the division of the pie. You don't want the pie to be divided among so many people, so you just pick the indispensable people. So usually it's just a handful of top staff. And they got the vested shares, but they don't have board membership. They don't have a say. The rest of the staff, of course, they are granted shares, but is unvested. That means they cannot sell it right after IPO. They have to wait for a certain time. Now here come the important people. One or more of the venture capitalists have to sit on the board. And of course, they have vested interest. The underwriters, they are also very important because they also put in money. Those are the investment banks or the regular banks or mutual funds. They also have to sit on the board. They usually assign one or more representatives to sit on the board. Of course, they got vested. Besides this, after they have figured out the division of the pie among just an exclusive few, they also need to think about control. So the venture capitalists and the underwriters will name a few names or recommend whom to be hired in key positions of the company. So what are the key positions? Besides the CEO, you have the COO, Chief Operating Officer, the Chief Financial Officer, or the Chief Accountant, maybe the General Counsel too, that is the Chief Lawyer of the company. These group of people, together with the Chief Executive Officer, form the top tier of the company. They are supposed to run the company and know what's happening to its financial health. And whenever something goes wrong or something goes right, they will feed the insider information to the members of the board. So the VC and the underwriters get the insider information from the people they recommend to fill these positions. The next big decision they have to make is to determine the number of shares to be issued at IPO. You cannot issue too many shares because the number of shares will be diluted and the price will come down. So they have to issue the right amount of shares based on the target price at IPO. And usually the number of shares at IPO is under 30 million shares. Now, what's going to happen at IPO time? At the time of IPO, when the shares go out to be sold, the board members will likely sell all their common shares to get a lot of money back. They will keep the preferred shares because the preferred shares represent the controlling interest in the company. They cannot sell them. If they sell them, they cannot stay in the board. At the time of IPO, there may be some other big players who will come in and buy up most of the shares from the board members because they think that the prospect of the company is very good. So in that case, the share will go up, maybe very rapidly, on the day of IPO or a few days later. On the other hand, there are some cases where the prospect of the company doesn't seem to be very good, and the big players don't come in to pick up the shares. In that case, the shares will be available to the public in the open market. In that case, you can imagine that the price may come down because no big players want to buy the shares and the board members want to sell them. Now, as time goes by, the membership of the board will change because some people will die, the board may have to expand and some new members will come in. But the new members have to fulfill at least two conditions. One of them, you have to be a major shareholder, or you have to be a hired gun, that is, you have to be a designated representative for a major shareholder. The other qualification is that you may have to be an indispensable person to the company because of your expertise.